Okay, well, thank you for that. Okay, now, all right, so resale cap rate. So here's the situation. Your original cap rate whenever you bought this property was 6.5%. And if you remember back to our whole discussion on cap rates, the higher the cap rate implies higher, starts with an R, risk, okay? So a higher cap rate, higher risk. Lower cap rate, lower risk. Now use the logic and explain to me why you potentially would have a higher cap rate whenever you bought the property and a lower cap rate whenever you sell the property.
Because the risk is decreased as time's gone on.
Okay, why?
The mortgage depreciation. I don't know.
No, I mean, think about it, why?
Does it have anything to do with depreciation?
No.
The mortgage, or the loan.
Good answer, but no.
When you're buying it, you got to maintain everything.
Okay, that's you're getting there. Okay, whenever you're buying, you've got to sort of bake in everything. But also, the simpler explanation is this. Whenever you go to sell this, you've got 5 years of operating history to sell it to someone. In other words, you bought it kind of sight unseen, just built, you know, don't really know how everything is going to work and that sort of thing. But after 5 years of operating this property, you kind of have the kinks worked out, hopefully. All right? And so you have, in essence, reduced the operating risk for the property, therefore, should allow the next purchaser to buy the property and not expect as high of a rate of return because you have basically worked out the kinks and ultimately you have the proof of how this property has performed over the past 5 years. Does that make sense? Okay.
So does that mean in the next 5 years when the next person sells it, it's going to go down even more?
Not necessarily. It's going to be kind of like one of those sorts of things that you reach sort of a maximum efficiency, you know, that that's the mathematic word. It's kind of like, what is it, decreasing returns or over time. In essence, no. It's just going to be that you pretty much within those first couple of years, is what we call it in real estate, we just call it, it's become stabilized. Okay? Stabilized net operating income. Stabilized, you know, sort of operations. That after you've owned a property, you know, for probably just 2 years, you've got most of the kinks worked out, and that's really where a lot of that risk has been kind of eliminated. And so those last 2 or 3 years of operation before you go to sell it or refinance it or whatever it is, you know, that's where you can sort of benefit from that. Now, this is where, I know that the time is getting later and so forth, but if you can make the logical jump to what I was talking about earlier with, at the end of 5 years, you have the choice of doing a couple things. What did I say?
Refinance or sell.
Refinance or sell, yes? Yes?
Yeah.
Okay. So what if you're not selling it?
Refinance.
You're refinancing it. Okay. Anybody see where I'm going with this? Where do you think I'm going, Paul?
Now that your cap rate's gone down, the property value's gone up,
And
your NOI potentially soon.
you're going to probably be able to refinance it for a larger dollar amount, meaning you can probably yank out some equity to take in, put it into somewhere else. Ah, yes. So in other words, basically, so what we're saying, let's just make sure I'm clear on this. What we're saying is if we apply this new cap rate of 5.5% to year 6 NOI, now I still haven't answered your question, but that's why I'm going right now. The cap rate is always focused on future income. And what I mean by that is the cap rate is always focused on what is next year's income going to be. Because I want to know what sort of a rate of return I'm going to get on it over the next year. In other words, whatever let's put it in simpler terms. You put $100 into a bank account today and you want a 5% rate of return, okay, or a 5% cap rate. That means that a year from now, that's going to have what? $100 is going to have $5 worth of interest, or basically the property is now going to be valued at 105. Does that make sense? Yes or no? Okay, so that's basically what we're pretty much saying here. Now, the point being is, so what we're saying is if we were to sell this thing or refinance it at the end of month 60, or 5 years times 12 months, month 60, then what we're really doing in terms of the valuation of the property using the cap rate is we're looking at the next 12 months worth of income from year 6 and then applying that expected net operating income to that resale cap rate of the 5.5% to calculate what is the resale value going to be at the end of year 5. In other words, it's IRV, nothing more. But once again, all we're doing is we're saying the income is $5,274,744.64, and our cap rate 0.055, meaning our value is $95,904,448, which should match up pretty close to this. Obviously, once again, do the rounding off a little bit, but you get the picture. Yes? Yes, 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 yes. Okay. Now, if you understand all of that, then we have one more little piece right there. Okay, now one more little piece is, okay, we have a loan balance that we are going to have to, at some point, utilize. Now, this loan balance is going to be how much money do we still owe after making 5 years worth of payments with our original loan amount of $55 million. Does that make sense? Yes or no? Okay, now, to do this with a financial calculator, actually, let's do it this way. We'll put it back on the other screen. It'll be easier. Okay. So, all right. Once again, clear your calculators out. Clear all. All right. What we're going to do, we're going to kind of put in the information kind of all over again, only to do the calculation. So we're going to put in 4.5% as our interest rate. 25 years shift as our term. We're going to put in our loan amount. We're just going to put it in as $55,022,573.43. We're going to put that in as the present value. You notice I'm kind of doing it a little bit differently, and I'm doing this on purpose. All right? And then what we're going to do is now we're going to solve for what is the actual monthly payment. Okay? -305 833.33. Yes? Okay. So everything matches up. We just kind of, now here's the thing. Just a couple of quick little calculator things to make sure that you kind of understand in terms of kind of the order you put things in and what matters, what doesn't. Okay, your three input variables, the interest rate, the term, the present value. You can put those three in any order you want. In other words, you can put the present value, then the term, then the interest rate. You can put the term, then the present value, then the interest, you know, those three can be in any order you want because those are the inputs, okay? The output variable, which is the last one that you're solving for, that obviously has to be last because you can't really solve for something if you don't have all the inputs, okay? So in this case, we're solving for what is the payment, so it's the last thing we solve for, and we get that. Now, one of the things the calculator has, which we will talk about, is what's referred to as an amortization function. And what that means, if you've taken, you know, like an intro to accounting or intro to finance, you probably, or you've had a car loan or home loan, any kind of loan, you probably have seen the thing where you've got like your beginning balance, your payment amount, the amount that goes to principal, the amount that goes to interest, your ending balance, you know, month by month, blah, 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 right? You've seen something like that. Okay, if you haven't, that's okay, we'll deal with that. But what the calculator will do is all of that for you, and specifically, what we can do is we can say, we want to know at any given point in time what the balance is on our loan. And the calculator will simply spit out that information. Now what I've set up here is we're basically asking the calculator to tell me for this loan from month or period 1 through, this input is basically just telling, it's kind of like just saying this through month 60, give me the amortization information for this loan. And what it's going to do is when you hit the equal the first time, excuse me, it's going to give you the principal amount. When you hit the equal again, it's going to give you the total interest paid over that time period. And when you hit the equal the third time, it's giving us what we're actually looking for, which is the balance of the loan. And so in this case, it gives you $48,679.42, okay, which should match up with the handout as the loan balance at end of year 5. $48,341,679.42. Okay? That makes sense, yes?
So say if you wanted to go back after you've hit equal 3 times, can you do that?
Yes.
Okay.
So what we could do, just as an example, you could say, all right, I want to know what the loan balance is after, let's say, okay, give me a year.
Like in this.
Yeah, you can do any time from 1 year to 25 years.
8 years.
Okay, 8 years. All right, so it would be 1 input. What is 8 times 12?
8 times 12?
What is 8 times 12? 8 years times 12 months in a year. What is it?
96.
96. Okay, so 1 input, 96, shift, amortize, equal, 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 and that will give you the balance at the end of 8 years. So let's just do that. 1 input, 96, shift, amortize, equal, equal, equal. 43,550,000, 649, 79. Make sense?
Yeah.
Now let's just for fun, the loan term itself is 300 months or 25 years. Okay, so let's just go halfway through, which would be 100, well, we've already done 96, let's not do that. Let's do maybe 180 months. That would be 15 years, okay? So after 15 years, or 180 months, one input, 180, shift input equal. You get like what, 25 million? 29 million. 29, 509, 651, 59. All right, now let's just, let's go like, just try to, let's go 200. One input, 200, shift, size equal. Okay, so this is, how many years was this? Oh, 25 years, I'm sorry, that's 300 payments, not 200. I'm in my brain, I was thinking it was 200. So 300 payments. I was like, why is that number so high? Okay, so after 300 payments, there we go. That's what I'm trying to get to. 0.000211089. So in other words, after 300 months or 25 years, your balance is zero. Is all that I was really meant to illustrate. But you can sort of see, it's kind of interesting that roughly, I mean, 150 would have been halfway, but we were at, let's say 180, but your original loan was 55 million, and you know, half of 55 million, so say 55 divided by 2 would be 27 million, would have been at halfway point, and you really don't reach that halfway point until after basically 15 years. So in other words, it's not, my point with that is that you would think that you would reach that halfway point after what? 12 and a half years. That'd be halfway through the loan. That's not the case, because with a fully amortizing loan, what actually happens is you're paying much more in interest at the beginning of the loan, and then at the end of the loan is where the principal balance is really being reduced. Okay? Does that make sense? Okay, all right. Okay, let's see if we can get through a couple more little calculations here, and then move on to the time-value money things. Now, here's the thing about time-value money things. They're basically sample problems, and what I have prepared in addition to what I've given you there is I've actually prepared all the solutions. So in the event that we don't get through them, you will have the solutions to be able to work through on your own and with all the calculator keystrokes, okay? So if you're getting panicked, it's okay, we'll be fine. All right, so let's finish up with this. Okay, now what we have, whoops, okay. Help I put the right screen up. Now what we have is, once we've kind of gotten the loan balance thing, we're going to be using that here in just a minute, but what we're wanting to do at this point is look at the property over the holding period that we had, which was 5 years. Because here's the thing, the calculations that we have done up to this point as it relates to rate of return have strictly been on a 1 year kind of snapshot. Yes? In other words, cap rate, rate of return, before tax return on equity, cash on cash, all of that's been kind of a snapshot for 1 year. But that's not all there is to the rate of return for a real estate property, because you have two ways you make money in a real estate investment. One is off of what we've been doing, which is the operating cash flow that comes in year after year after year after year, and you're getting that money each and every year off of the operations. But the second way that you make money is off of the sale of the property, off of the capital gains. So in other words, here's the thing, let me make sure I make the logic train as clear for you as possible. You could have a property that you buy today and it generates no income whatsoever for the next 5 years. As a matter of fact, it could have holding costs that actually cost you money for the next 5 years in terms of property taxes, insurance, like raw land would be the perfect example. You buy a piece of raw land, you still have to pay property taxes, you probably have to pay some sort of liability insurance in the event that somebody goes out there and falls or hurts themselves on the property. This is why you see so many fences around, commercial properties that haven't yet developed, because they don't want people out there potentially hurting themselves, yada, yada, yada. Anyway, but the point is, you could have this piece of raw land that you bought at the beginning of 5 years, you have to pay all these holding costs of property taxes and everything else, but then you go to sell it at the end of 5 years, and it's very possible you could make an outrageous rate of return on that property without generating any income for that 5 years, simply because you're selling it for so much more than what you bought it for. Very simple concept, yes? Okay. You could also have a situation of where you buy it for whatever price that you bought it for, and it generates a fair amount of income each and every year for 5 years, and then it's time to sell at the end of 5 years, and there's just not a market to sell it because maybe economic conditions in the overall environment have changed, and so therefore there's maybe, you may even have to sell it at a loss if you want to sell it, but you can still hold on to it and generate operating income. Does that make sense? The ideal situation is, of course, you buy it, you generate a lot of operating income, and then when it's time to sell, you sell it for a nice profit, and then you take the profit that you made off of the operating income, and in essence, add it to the profit that you made on the sale of the asset, and then the combined return is hopefully something really awesome. Does that make sense? Okay? Now, of course, you could have the complete lose-lose situation. You buy it, it makes no money, loses money every single year, and then you sell it, 5 years later at a massive loss, and you've lost everything. Okay? That's also possible as well. Okay? Now, so here's what's happening in terms of these numbers. This first number, this first column, is basically making the assumption that if you had paid cash for the property, there's no loan associated with the property. So the original amount here that you would have invested at the very beginning of all of this, at time period 0, 73 million, what number does that represent? The original purchase price, yes? If you look back on your sheet, original purchase price 73 million, or implied value. Then the operating income, the net operating income that you then receive each year would be added in there for each of the first 4 years, simply as written on the sheet, and you see where those numbers are coming from, yes? In other words, not trying to pull any fast ones on you. Let's just kind of look back up here. So in other words, if you look across here at those net operating income numbers for each of those years, those numbers there should match the numbers here. Does everybody see that? Yes? Okay, so all we're doing is pulling those numbers down. Now, what you see here at the end In the 5th year, what happens in the 5th year? You sell it. So, what money do you receive in that 5th year? You still receive your 5th year NOI, but now you get the resale price for the property. Well, what was the resale price, assuming no loan was involved? 95 million. Okay, so just to make sure that you're paying attention, take 95 million, or well, let's actually do this other way. Take 101, 074, 331.75, this number here, subtract out the 95, 904, 447.95, and you end up with 5169883, which should be, yep, your year 5 NOI. Does that make sense? So all you're doing in that year 5 is just adding the resale of the property with the 5th year NOI together. Because that's the income, all the money that's coming in your door at that point in time. Make sense? Okay, another, just in case it's not making sense, think of it kind of like this. This is a simple example I used for many years. Think of a piece of real estate. It's almost like a coin-operated vending machine, okay? And you buy it up front for this price, like a Coke machine, okay? And then each year, yeah, you fill it up, you know, whatever. And at the end of the year, you empty out the coin box, and then you pay whatever bills you've got to pay, whatever you have left over, then there's your NOI. But then at the end of 5 years, once again, you empty out that coin box, you pay all your bills, you take that, and then you sell it to somebody else, and then whatever you sell it to them for, then you add that to the money you got from the coin box, and there you are. Make sense? Yeah. Okay. Now, what we do at this point is we calculate something called the internal rate of return, the IRR, okay? Just out of curiosity, how many of you have had finance or accounting where you've done internal rate of return? Anybody? Okay, so 1 or 2 of you? It's okay. All right, so let me just explain very basically the internal rate of return. What it's doing is it's taking all of these numbers and in essence saying, you spent this much money here, and you got this much money here, 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 and here, and takes into account the timing of these cash flows in the sense, this one occurred at the end of a year, this one occurred at the end of year 2, 3, 4, and 5, and it sort of meshes all of that information together to then give you an overall annualized rate of return. So what we're saying is that for this property, taking all of that information together, we're getting basically an 11.62% annual rate of return on this property. Does that make sense conceptually? Okay, we're not doing the numbers yet, but I mean, but conceptually, does that make sense? That over that 5-year period, in other words, here's another way to look at it. If I gave you $100 today, then what you're saying is each year you'd basically be adding 11.62% to that balance, so that next year you'd have basically $11.62 worth of interest off of $100, the next year another, and so forth, so on, for the next 5 years. Make sense? Okay. All right, so what we're going to do, let's go talk about the NPV and the NPV rate. Okay. If I were to just simply ask you, what sort of a rate of return overall, not just the cap rate, but overall, do you want on a property that you invest in? And this is quite common with most investment firms. They're going to say, we have some sort of a pre-established base rate of return that we want to receive. Okay, kind of like, it's sort of saying it's our minimum return. Also, another word for it is called the hurdle rate. And the reason called a hurdle rate, it's something you have to be able to jump over, okay? You have to satisfy that requirement. And if you satisfy that requirement, we're going to be happy. If you don't satisfy that requirement, we're not going to be happy. Okay, make sense? All right, so in this case, we have set that hurdle rate at 10%. Okay, so what that means is that this investor, they absolutely positively want to get a 10% rate of return. Now, why they want to get 10%, that's up to them. But that's what they want. They want a 10% rate of return. It's much, it would be as simple as this. It's kind of like, say that in addition to the debt money that you got for investing in this deal, that maybe the equity money, instead of it being, you know, a inheritance or thing like that, that it could be that you've got an equity partner, in other words, a rich person, that in essence, they're going to be, quote unquote, maybe the silent partner in the deal. You're going to do all the legwork, all the background research and everything else. And what they're going to say to you is, look, I want 10% of my money. You can keep everything else on top, or we split everything else on top. That's a whole, you know, other sort of deal structure sort of thing. But at a minimum, they want their 10%. Does that make sense? Yes? Okay. So, what that, in essence, does is, with the calculator and with Excel, the calculations that it does, in essence, what it's saying is that an 11.62% is what the actual return is on the deal. But if we're demanding a 10% rate of return, how much profit, in essence, are we making above that 10%? In other words, what's the difference between these two in terms of the dollar amount? That's what this number represents. Okay? So what we're basically saying, if we kind of go back to my scenario I was sort of pitching it earlier, that we give our investor their 10% rate of return, and we get to keep everything else, we would then be able to keep 4.9 million. Okay? Does that make sense? In terms of hard cash currency, after everything is said and done. Now, what if they, and this is where the power of Excel and the calculator obviously come into play, but what if they said that their hurdle rate was 11%? Whoa, look what happens to us. Now we're only going to be getting 1.8 million. Well, what if they say 11.5? Oops, 11.5 is their hurdle rate. You see what's happening there? It's converging. Okay, what if it's 11.6? Okay, 11.61. Oops. Okay, now, once again, do the rounding, okay? Because actually, you've probably stretched the decimals out. So, but the point being is, what's really happening here is that they demanded a hurdle rate of 11.62. That's what the project is actually yielding. Therefore, they're breaking even with their money. Actually, they're losing a little bit only because of, once again, because of rounding. Okay, this should be 0. Okay, but it's only because of rounding that it is not, and we're dealing with such large numbers. That's the reason why there's that much of a difference. But my point is, what if they demanded a 15% hurdle rate, way in the negative? So they would be very unhappy with you. You would get no money, and they would be wanting to chase after you for $9 million. Okay, does that make sense? Okay, conceptually. I mean, I understand the math and the calculations, you know, may not, that's okay at this moment. Okay, all right. But this also means that, you know, if you kind of go down dramatically, what if they only demanded a 5% hurdle rate? Tons of money. What if they didn't demand anything and they let you keep all of the profits? You walk away with 47 million bucks. Or another way of looking at that is if there were no partners, That's the actual cash that you would walk away with in this deal.
That's how much you made since you purchased it 5 years ago.
Right. After everything is taken into account. Okay? We feel better? I know we're wearing out, but I mean, we feel okay? All right. All right. Put that back at 10%. Okay. Now, this side, the before tax cash flow. Same general concept as one on this side. The difference with the numbers is this one is taking into consideration the loan that you got. Okay? And so the reason why this is only 18 million instead of 73 million, this represents just what? Just your equity. So this is, basically saying, we don't care how much bank money you basically put into this. What matters is how much of your money did you put into this, because we're calculating the return on your money, not on the bank's money, on your money. So if that's the case, then that's the equity that you put in. And then these dollar amounts represent what? The before tax cash flows for each year. Yes? Okay, nothing new there. But now what you see at the very end is a substantial difference with the payout at the end. Why? You still have a bank loan you have to pay off. So that number basically represents, this 49 million represents the year 5 before tax cash flow plus the loan balance at the end of year 5. Does that make sense? Because you still have to pay off that balance to the lender. Okay, so we go through the same brain damage of doing all the calculations, or the computer or the calculator does. But here's what's fascinating. Because of the benefit of positive financial leverage, and what that means is you're borrowing money at a lower cost than the project is yielding, that you are able to magnify your rate of return. This is why people love to invest in real estate, is because if you can put a relatively small down payment and control a much larger property, that the property does well, that will only magnify your rate of return. And so in this case, that's exactly what happens. You're now getting on just your money, because keep in mind, this was assuming it was an all cash deal. This is assuming you're borrowing the money, which is the real scenario. And so instead of getting that 11.62%, which wasn't horrible, you're actually getting a 25% rate of return, okay, by getting that bank loan. So it magnified your rate of return. Now, in terms of the hurdle rate, we keep it still at, let's say, at 10%, but this also, under the same sort of scenario, that if you were doing this with a partner, and once again, they let you keep anything above and beyond 10%, you would much prefer this deal, because now you're going to walk away with 16 million. But this is the part that's sort of interesting. If we go in and we start changing this, let's say, once again, the same general scenario, we go up to, let's say, 20%, but obviously it gets kicked down quite a bit. We go up to 25%, gets kicked down some more, go to 25.91. Obviously, it's, should be 0, but you get the general idea, just like we did previously. But now let's kick this one all the way down to 0. 35 million. Now wait a second, wasn't the other one a lot more money? Yeah, it was. Let's go back over here. So the reality of the situation is we walk away with less money over here than we do over here, but, we didn't have to put in as much money. We basically 25% equity, yes? Okay, now this is the part that's going to blow your mind and you're just going to go, okay, 25% equity. Everybody agree that's what it was on this property, yes? Okay. With 25% equity, now try to focus just for 2 minutes, okay? What could we do? We could do this investment 4 times. Because if we have, in other words, you follow what I'm saying? This one would require, 100%, equity, but this over here is requiring 25%. So if we did this one 4 times, in other words, 25 plus 25 plus 25 plus 25, we could basically magnify this number by 4. Okay, in other words, think of it like this. This is one property. Well, all of this is one property. But if we were able to do this 4 times, that means that we basically would own 4 properties instead of just owning 1. That's the beauty of real estate, is that leverage. But all of that positive stuff gets counteracted by the negative stuff, because if the market goes down, you lose everything. And by everything, I mean you lose all your equity, because the bank is probably going to get everything. So you got to be very careful, and a lot of, older, savvier real estate investors will pretty much tell you, try to limit the amount of debt that you take on in the event the market does go down, because inevitably, in most cases, it does go down, okay? All right, you feel pretty good about that in general? Yes? Okay, you're exhausted, you're worn out, you want to quit, but you're not done yet? Okay, all right, do this, take a quick 5-minute break, we're gonna come back, and then we're gonna work on these sample problems. And I promise you, those are gonna go pretty quick, okay?
FIU already canceled classes.
What?
FIU canceled.
We haven't.
Wait, I just checked. Yeah, FIU. So FIU, no one knows.
Well, ULM canceled this afternoon already. So.
Can they I don't have classes tomorrow anyways, but can they just cancel them anyway? So I can spend time with my roommates and we can all...
stay here until the last minute. They'd rather...
I just want to stay in the dorms. I don't want to evacuate.
I don't need tomorrow.
Because if we evacuate, I have to go to Orlando, and that's not better. That's my issue. Going to Central Florida is not the ideal situation right now.
Wow. So you got Let's see, it's your Thursday, Friday.
I wanna go home.
I think Tuesday's the weekend.
You know
for sure.
what's
It's
okay,
gonna
it's not that
Yeah.
bad. It's bad about this. So Tuesday was the beginning of this week. What during was my birthday. My mom was kind of motivated. So on the phone with her. It was a tropical storm then.
Yeah, I know. I was like, wow.
I was
she got
like,
busy.
yeah, you guys are not even. I was like, yeah, so you guys are gonna go through the storm without me. And then they were like, oh yes, and I was like, wow, so I have to go through the storm without my sister and my mother.
I heard that was like
This is
way
good.
inland, like past us.
Oh.
The question is,
I want my sister. They're not coming back for like another 2 weeks. And so when Irma hit, my sister was, she was Irma hit us in September.
Irma hit us the week after Labor Day weekend. So right now, Dorian's a week early.
So yeah, it was. So that was September. My
I'm
sister
gonna call her
was
Dorian because it's
2
nasty.
months old. She was 2 months old.
I gotta charge all of my battery packs and my Nintendos.
Irma, they announced on Wednesday.
Tuesday.
I'm putting my ice cream in the.
Yeah,
Oh
they
my
usually
god!
do
I'm putting my ice cream in the washing machine.
And Irma came.
Save my lactose intolerant ice cream.
Yeah, I think they'll cancel Tuesday for sure. Wednesday probably for plan. I think the soonest we'll be back is Thursday.
That's like.
Just in time for class.
I know.
Welcome to President.
I mean, for Irma, we were out for about a week.
Yeah.
So I think like 2 days max for Dorian.
Yeah.
We'll see.
I'll miss. My essays are still probably gonna be due. That's what my issue is. My
all
essay is still
all my
due on
stuff's
Thursday.
online, so it don't matter if I have no school or not. So.
Majority of my classes are online. I only go to 1 class a day, except for today I have 2 classes.
None of mine are online. They just have all their assignments online, so they'll make you post them or what. Yeah.
I just don't want to turn things in on Thursday when I'm like, I was crying about a hurricane. Can I Can we delay this one?
Can we get like a little
Like, they know exactly.
She was like, nah, y'all should have been writing that essay during the
during her people? We ain't have no power. We ain't have no
Miss.
Yeah.
ma'am.
Oh,
Yeah,
I have to
so you said
download
nine,
all of
so
their
it's
teachers.
supposed to go
Okay, we got it right now. You still missing
I just
anybody?
started it today.
I think two people.
30 minutes in.
Over there,
First
okay.
episode.
Okay, so we're going to pull out the third and final handout. The one that obviously starts with question 1, compound or future value. Okay, these should go pretty quick, and once again, whatever we don't get through, just sort of show you, tease you, and tempt you. We got the worked out solutions, keystrokes, so that you can kind of go back and, I'm not that. There's a method to the madness. You never hand those out while we're working on them because everybody's just going to stare at those and not what I'm doing. So, 30 years doing this, I know what to do and what not to do. Okay, so starting with this first one, the compound or future value. Take a look at what's being asked. What is the future value of a property at the end of 15 years whose present or current value is $150,000 and is expected to appreciate at 4.5% per year compounded monthly? Okay, so here's how you're going to start every single problem. Clear all. Then the second thing you're going to do is you're going to identify how many compounding periods we're dealing with, whether we're dealing with monthly or we're dealing with annual. So with this one, it makes it pretty explicit, it's monthly. So 12 shift payments per year, okay? Then we pretty much just put in the basic information that kind of, you can do it in any order as long as you end up with what we're solving for. So we're basically, so you basically have a time period of 15 years, so 15 shift in. You have the present value of 150,000 and the interest rate or the growth rate or appreciation rate of 4.5%. And we're going to solve for future value. So let's just, I'm going to kind of just show you in essence what we're sort of doing here. So this is, well, because of the way we put it in, I'm going to explain that as well. All right, so over 15 years, we're saying that if we bought something here for 150,000 and it grew in value at 4.5%, how much is it going to be worth at the end of that period? So putting all that in. Yeah, and ignore the negative for the moment. We're going to talk about that, okay? Okay, 15, shift in, 150,000, present value, 4.5%, 294,000. Okay. So, I'm going to come back to the negative here thing in a minute, okay? But here's where I want you to try to understand what this problem is all about. This is probably the most common sort of real estate thing you can sort of almost run into. And so what you're saying is, this is the kind of thing, you've got land that you bought 15 years ago, or land that you bought today, and then you want to see 15 years in the future. But either way, what you're just simply saying is, we paid this for it, and it's over that time period, and it grew in value by that much. How much would we have to sell it for in order to achieve that? That's really what we're sort of boiling it down to. Does that make sense? Now, let's talk about the negative thing. Okay. The calculator looks at everything as an inflow or an outflow. Okay, whenever it comes to present values and payments and future values. Who is receiving money, who is basically giving money. Either way, receiving or giving, all right? Because there's two perspectives to every transaction. So let's say that I'm the lender, you're the borrower. in a lending borrowing situation. All right? From my perspective, I am giving you money, therefore it's a negative to me. But to you, your perspective is just the opposite. You're receiving that money, and then you're making payments to me, which is a negative to you, but it's a positive to me. Okay, now in this scenario, what we could be saying is, well, actually what we should be saying, let me actually move back that up. The best perspective to look at this one would have been to actually make the 150,000 as a negative, therefore this is a positive, okay? Because that's gonna make the most sense. Because what we're sort of saying is that if we make this a negative, then we're spending $150,000 here to buy the property, and then at the end of 15 years, we're getting back $294,000. Now, here's the thing. At this point, I almost ignore a lot of the pluses and minuses because I'm sort of accustomed to, okay, I know what to look at and avoid a keystroke or two, that sort of thing. You, on the other hand, probably need to always be thinking about what is an inflow, what is an outflow, and be consistent with that. And that's part of the reason I sort of did this way, was so that you could kind of see what actually would happen is to be able to put this 150,000 in as a negative, you use the change sign key, which is on the left-hand side of the calculator, on the far left, 4 keys down. You see it? All that does is change whatever's in the display to a negative number, or a positive number if it's a negative. Okay, good? Moving forward. Okay, present value calculation. All right, so this one, once again, clear all. In this case, monthly or annual? Annual. One payment per year. Okay? In this case, we want to know what the value of the property is today if its future value is predicted to be $5 million. So $5 million would be what we would be receiving in the future at the end of 5 years, assuming an interest rate or discount rate. Now this is another thing of 7.5% that a lot of different words used to describe the same thing. And what I mean by that is interest rate, discount rate, compound rate, growth rate, rate of return, cap rate, so forth, so on, hurdle rate, they all are basically referring to the interest rate. It's just a lot of different words that do have some nuanced meanings, but for the most part, they're just referring to an interest rate, okay? So you pretty much are just going to be singling out the word rate, okay? All right, so this one, okay, so what we'd be saying is the property would be worth today $3,482,793.16. Right, matching up? Okay.
Yeah.
So once again, if we were to put a little timeline of sorts, what we're kind of saying is, all right, we get $5 million positive at the end of 5 years, 7.5% growth rate, and then ultimately solving for what is the present value here, $3,482,793.16. Okay, make sense? Yep. Okay, moving forward. All right. Present value of an annuity. Okay, an annuity is basically just a payment. Okay, An annuity is simply a dollar amount that you either spend or you receive on a regular basis. Could be annual, could be monthly, but in other words, think of it as just like it's a monthly payment, or received or spent. All right, so in this case, is this monthly or annual? It says monthly. So clear all. Monthly, 12 payments per year. All right, and you're receiving $2,500 as a payment. So that's going to be a positive number to you. You're receiving it for 60 months. Now here's something new. Instead of entering this in as 60 shift in, we're going to just simply enter it as 60 in. The reason is, now if we had said, well, you're receiving for 5 years, you could have put 5 shift in and that would have made it 60. But here, since it's already been converted into the number of months, you simply put it in as 60 in, or 60 months. Does that make sense? Okay. And then they're asking for what is the present value of these lease payments, assuming a 4.5% interest rate. So present value, okay, do that one real quick. $134,098.45. So let's explain what this is. Another way to look at this, what are the value of these lease payments to you as the owner of the property? Or how much are you really expending if you're the tenant of the property? Okay? What we may want to know is if we could do a trade-off today where you prepaid your rent for the next 5 years, what would be the total dollar amount that you would need to prepay? Well, you could just say, okay, well, if that's the case, why not just simply take $2,500 and multiply it by 60 months,
You're not getting interest.
and you get $150,000. Well, what we're actually doing is we're saying we're actually going to give you, in essence, a 4.5% sort of discount off of this amount if you were to sort of pay it all now up front. Because what can happen, here's, I don't want to get too deep into this, we're running out of time. Many years ago, well before probably, or about the time that some of you were born, back in the late 90s, early 2000s, we had the whole dot-com bust, which you may or may not have heard about. And long story short, you had all these internet companies that had started up in the mid-90s. They all got massive amounts of funding, and they really didn't know what the heck they were doing for the most part. And many of them went out of business pretty quickly. But they had a lot of cash up front. Well, the real estate story is the one you probably have never heard. That is, many of these dot-com folks went to try to rent real estate from a lot of different folks in Texas. This was huge in North Texas, specifically in the Dallas area. And most of the property owners would say, we're not going to rent to you because we don't believe in your business model. I don't care, if you've got all this money, we're not going to rent to you because we don't think you're going to be in business next year. And they were basically right. But what they said is, we will rent to you if you prepay your rent for the next 5 years or 10 years. And so what they would do is something basically kind of the equivalent of this and say, okay, your rent's going to be $2,500 a month for the next 5 years. Just write us a check now for $134,000. Does that make sense?
Oh, well, yeah, it makes sense, but it's.
But then what would happen, the company goes out of business a year later, the property owner gets to keep all the money, and the tenant or the space just remains basically dark. And then you can rent out again. So, anyway. All right, moving on.
And that's why they discount it?
Because they're simply prepaying it, they're getting the money up front,
Yeah, okay.
and reducing the risk.
I use it on.
Okay, moving on. Accumulation of a future sum. All right, so here, simple example, you need to save up some money to replace the roof. You know the roof is probably going to need to be replaced 15 years from now. How much do you need to deposit annually to accumulate the $500,000 in a savings account that earns 3.5%? Okay, so this is annual. All right, we need to save up $500,000, so that's going to be our future value. This is going to be in 15 years. So we either put it as 15 in or 15 shift in because it's only one payment per year. 3.5% is our interest rate. And the amount that we're going to need to deposit annually is going to be a payment amount. Okay? It's going to be a reoccurring amount. Okay? $25,000 a year is the dollar amount that you would have to basically set aside each year to make sure you have this money 15 years from now. This is, once again, a very common real estate problem that a lot of commercial property owners sadly don't do because you're going to have to replace your roof every so often. You're going to have to replace the air conditioner every so often. You're going to repave the parking lot every so often. You're going to repaint the building every so often. You're going to have to do all of these things, but unless you set that money aside in some sort of a sinking fund, you may not have the funds to be able to do that. Now, some lenders will require you, in some instances, to set aside a reserve account to take into account some of these things, but other lenders don't. So anyway, everybody understand the problem? Okay, moving on. Okay, question 5, present value of perpetuity. All right, so here we've got a property that generates an annual NOI of $20,000 a year into perpetuity. Assuming that they can earn 6% annually, what is the value of this perpetuity? So it's basically ERV, okay? So 20,000 divided by 0.06, $333,333.33. Now, another direct application of ERV, scholarship money, like with universities, okay? Another way to look at this is if I donated hard cash currency today of $333,333.33, and the university took and invested that money, and they were able to earn 6% a year, they would be able to then pay out scholarships forever and ever and ever at $20,000 a year. Does that make sense? And that's how scholarship funds work. Okay? Perpetuities. It's also the way, we're running out of time, but all these great stories to tell. It also is the way cemeteries work. Cemeteries. Because they have to perpetually take care of mowing the grass, you know, maintaining the property. So whenever you buy a cemetery burial plot, one of the things you pay into up front as a fixed fee is a perpetual care fund fee. And then interest off of that is what basically pays the bills to keep it mowed and maintained in perpetuity. Didn't know that, did you? Okay, moving on. Number 6. All right, got a property, you want to buy a piece of land today, sell it for $350,000 at the end of 25 years, what's your rate of return? Okay, in this case, this is annual. So clear everything out. 1 payment per year. 100,000 is what you buy it for, and so we're going to make that a negative present value. We're going to sell it for 350,000, make that a positive over 25 years. What are we going to be solving for? The rate of return or the interest rate. Now, a big piece of this problem that almost everyone gets wrong the first time they do it is they don't put the change sign negative. If you put both of those numbers in as positive numbers, the calculator explodes, because in its mind, it's basically saying money's falling from the sky, therefore there's no way to calculate a rate of return. It's infinite, okay?
Wait, is there a way to do that everywhere?
All right.
I wish.
All right, 5.13 or 5.14%. Okay? So that would be your rate of return for that investment over that length of time. Now, one thing I would do, if we had more time, would be to illustrate one other little quick concept. Let's just say, instead of holding that for 25 years, we only held it for 10 years, but that same dollar amount applied. All you would change would be the term, and then resolve for the interest rate.
So you said we do all of this, okay, we just hit.
So what I'm saying, okay, this is the answer to the problem, but what I'm saying is, what if we were to say, instead of holding this thing for 25 years, we only hold it for 10 years, but yet we get the same investment, same dollar amount return. Makes a huge difference in terms of our annual rate of return. This is the whole thing. I mean, like I said, all this kills me. I don't have enough time to get all through all this. But it's how many times have you heard people say, I remember hearing this the whole time when I was growing up, I bought this piece of land 50 years ago and I paid $10,000 for it, and I sold it last week for $20,000. I made a 100% rate of return and doubled my money. Well, they did double their money, but they had to wait 50 years to do it. That rate of return is almost non-existent, or not non-existent, but it's infinitesimally small because they held it for so freaking long, okay? So that's the impact of the holding period. The shorter the time you can hold something, the better. Time is money, simple as that. This is, All right, moving forward. Okay, question 7. All right, another yield calculation. So in this one, it's also annual. Clear everything out. 1 payment per year. Okay, in this case, we buy a property for $100,000. That's going to be a negative present value. We generate $1,000 a month of positive income as a payment. We sell it after 15 years. Oh, hold on, okay, this is monthly. Yeah. Oh, okay, yeah. So we do want to make this 12 payments per year. My bad, I misread whenever I looked down there under annual rate of return. Okay, 15 years, and then we sell it for $200,000 as our future value. Solve for the interest rate or rate of return. $13.98, right? Okay. All right. 13.98 for that one. Okay, number 8, internal rate of return. So this is very similar to what we had on the actual spreadsheet, but here, so this is going to be annual. Clear everything out. 1 payment per year. All right, this one will be a little bit different. You're going to have 200,000. That's going to be a negative, and we're going to put this in as a cash flow. This is a new key on the calculator. If you look on the calculator, it is the 3rd row, 3rd column, CF sub J. Okay? Now I'll explain that in just a second. All right, and then we have annual cash flows for the first 3 years of $30,000. So we're going to 30,000, CFJ, 30,000 again, CFJ, 30,000 again, CFJ, and then 45,000 in year 4, 45,000 in year 5, and then we also sell it in year 5 for 400,000. So we're going to add that to that final year's cash flow, just like we did in the problem on the spreadsheet. Equal cash flow J, and then it's going to be a matter of just solving for the internal rate of return. So this is the same thing that we basically did on the spreadsheet, but the calculator key for internal rate of return is right underneath. It says shift underneath the CST button. You'll see IRR/Y year. Okay? All right, so let's see if we can do this one real quick. I get 28.37 rounded. And if you're still struggling to put that in, that's okay. All right, let me kind of explain this one real quick. We have 2 or 3 minutes. So in this one, it's very basic. We bought the property for $200,000. Each year, we sort of emptied out the coin box. We collected the operating revenues. Those were $30,000 for the first 3 years, $45,000 for the last 2 years. We sell it at the end of 5 years for the $400,000, and so we're simply saying, what is our overall annualized rate of return for that 5-year holding period? That's the 28.37. Okay, make sense conceptually? All right. Now the next question is that same question, but assuming your hurdle rate is 15%. So all you're going to do is just follow that with putting in 15% as your interest rate, top row of the calculator, just as always, and then you're going to hit Shift NPV, which is right below the PRC key. Okay, and when you do that, all right, should be 115. 469.30. So that's, once again, that's the answer to question number 9. Okay? So just like in the example that we did on the big spreadsheet, this is saying if our hurdle rate is 15%, the project is actually generating 28%, then the real profit that we're receiving above and beyond the 15% is $115,000. Okay? Looks like I've got time for one more. Okay, this is a really simple one. What's the monthly payment to fully amortize 6,770.5% interest rate or mortgage over 30 years? So this is, they're all 12 payments per year. 6 million as our present value, 7.5% as the interest rate, 30 years as our term, Going to be solving for what is the monthly payment. Okay, just double check, make sure everything's working. Payment, $41,952.87. Okay? All good? Okay, we're gonna stop there. Now I'm gonna give you the solution sheets. Okay, so everything that we have just worked is here. Everything, the remaining 10 questions on here are also on here. So what you can do is obviously work through these. I can probably, you know, if I need to, come back and see you in a couple of weeks, or you can potentially give me a call, stop by, whatever. Okay. Well, outside of being exhausted, do you feel like you learned anything? Yeah. Okay.
I'm gonna go over this for a minute.
Now the meeting is
What?
Done.
Good.
Stay safe, guys.
Thank you. You as well.
Actually, here's some others.